As we enter the final month of the financial year, it's time to gear up for annual closing with key regulatory updates and reminders for year end. To introduce the new amendments across regulators and decode financial reporting considerations for the year end, we've invited CA Vishal Diwarkar, partner and head audit and assurance, MSK and Associates, chartered accountants, to commence InSync's 2023 journey. Many thanks, Vishal, for being here. Without much ado, handing it over to you. Thank you.
Thank you. So, welcome all to this series where we look to cover certain key amendments that have taken place across various regulators in the recent past. We begin with amendments across our capital markets regulator SEBI, MCA, and also a reminder on certain financial reporting considerations with respect to Schedule 3, which was introduced for the first time last year and posed certain practical difficulties for companies. We will look to cover further updates and reminders in our next episode as well. We begin with the capital markets regulator. The amendments to the SEBI listing regulations seek to further strengthen Indian corporate governance practices, enhance the disclosure requirements, and align to global standards. A few of the amendments also streamline some of the requirements and ease the compliance burden on listed companies. Starting with BRSR, or Business Responsibility and Sustainability Reporting, which was made applicable for the first time to top 1,000 listed companies by market cap for this financial year. This replaces the BRR, or the Business Reporting and Responsibility Reporting framework that was prevalent till last year for, again, top 1,000 companies by market cap. SEBI has prescribed a particular format for the BRSR reporting, and there's a guidance note as well to assist with implementation. The disclosures are aligned to the 9 principles of the National Guidelines on Responsible Business Conduct, or NGBRCs. Globally, the IFRS Foundation had set up the International Sustainability Standards Board, or ISSB, which released 2 exposure drafts for sustainability and climate-related disclosures. As of now, SEBI is going ahead with its own BRSR, and only time will tell whether this would align to the ISSB standards in due course. Now, what does this mean for companies? Firstly, there is an immediate need for boards and audit committees to understand and set the agenda for sustainability. Secondly, companies should start evaluating the new reporting requirements of BRSR and assess their level of preparedness. There would be an immediate need for companies to start investing in systems and processes to capture the ESG data for reporting and establish a level of assurance on such reporting to build the trust of investors and other stakeholders. With the BRSR implementation, businesses in India are expected to reach higher disclosure levels in their quest to be socially, ethically, and environmentally more responsible. I have no doubt that assurance or external assurance over such reporting will not be far behind. Related party transactions have been a hot topic for a number of years across various stakeholders, be it shareholders in the audit committee, standard setters, tax authorities, to the investor protection community at large. SEBI has introduced further amendments in this regard and has reiterated the importance of empowering shareholders in terms of reviewing and approving RPTs. The amendments issued by SEBI not only aim to widen the gamut of related parties but also strengthen the related approval and disclosure processes to assist audit committees and shareholders to make informed decisions with respect to related party transactions. These amendments are now also applicable to high-value debt-listed companies on a comply or explain basis up to 31st March 2023 and on a mandatory basis with effect from 1st of April 2023. So what are the key changes? Firstly, the definition of related parties is now enlarged. All promoter and promoter group companies, irrespective of their shareholdings, would get covered. Also, those who are not in the promoter group but where shareholding is 10% or more with effect from 1st of April 23 would also be covered in the definition of related parties. As a result, a careful consideration would be needed where there are entities controlled by such persons or where two or more persons act in concert. While SEBI may provide further clarifications in due course, large groups with complex structures may require detailed evaluation. Second amendment relate to transactions of the listed companies with its subsidiaries and also those transactions that the subsidiary enters into with its own related parties would also require prior approval of audit committees. These subsidiaries, regardless of where they are based, would be covered for this amendment. All subsequent material modifications to RPTs will also require prior approval of the audit committee. As per the amendment, the threshold for RPTs requiring a prior approval has been reduced. The new threshold is 10% of the consolidated turnover of the listed entity, which was applicable up to 31st March 2023, which is now further reduced to 10% of the standalone turnover of the subsidiary. This threshold of 10% of the turnover of the subsidiary could be fairly low and is likely to increase the number of transactions that would need to be pre-approved. This means the onus on management and eventually the independent directors has further increased. Thirdly, now as per the amendment, prior approval of shareholders is required for material related party transactions and material modifications to related party transactions. The amendments have now harmonized the requirements of the listing regulations with those prescribed under the 2013 Companies Act. Accordingly, audit committees of companies will now need to define what constitutes a material modification of a related party transaction and include it in its policy on dealing with RPTs as per the regulation. The materiality thresholds now include transactions exceeding 1,000 crore or 10% of the consolidated annual turnover of the entity, whichever is lower, with effect from 1st of April 2022. And such transactions will require prior approval of shareholders. Therefore, entities will now need to plan and identify related party transactions upfront and take the necessary approvals from shareholders before entering into such transactions. Listed companies may need to hold additional meetings for such transactions that fall in the ambit of related parties and seek the necessary approvals. Certain clarifications on routine transactions could ease the burden of compliance. For instance, where shareholding exceeds the 10 or 20% in case of institutional investors such as banks, insurance companies. However, this clarification is yet to be received. Moving ahead with initial public offerings, SEBI introduced the concept of confidential filing of IPO papers last year. This is not a new concept globally, and in developed markets such as UK, US, and Canada, this has been prevalent for some time. What is the need for a confidential filing? As you all understand, the DRHP contains a lot of sensitive business information. If for whatever reason the company decides to withdraw its IPO plans, all this information is in public domain, which could be commercially sensitive. Hence, this new provision voluntarily allows companies to file their IPO papers confidentially with SEBI. Tata Play, as you may be aware, was the first Indian company to have opted for this rule. The only constraint in a confidential filing is that typically extensive marketing of the IPO is not permitted except with QIBs where one gets to test the waters. Only once SEBI comments are addressed and the updated DRHP is filed would one be permitted to market the IPO. The other notification that was formalized was with respect to disclosing of KPIs in offer documents. While there was always detailed framework for presenting financial information that required audited financial statements, restated financial statements, need for peer review auditors, etc., there wasn't anything specified for operational KPIs. After a consultation process, it currently has been proposed that all relevant KPIs should be disclosed in the offer document, and the audit committee of the company should confirm this fact and also have the stat auditor or an independent chartered accountant or a cost accountant, as the case may be, to certify such KPIs. The social stock exchange concept was introduced for the first time in the 2019-20 budget. The SEBI circular lays down detailed provisions for non-profit organizations in India to get listed on an SSE. Social enterprises will now have access to public markets and thus assume greater responsibility for increased transparency, enhanced disclosures, and independent assurance on impact assessments and accountability to investors of the ultimate usage of such funds in line with stated objectives. SEBI has therefore put in place adequate safeguards in the SSE framework itself. For instance, only NPOs having a minimum track record of 3 years can get registered on an SSE. These requirements are in the right direction and provide a new avenue for social enterprises to access capital. To facilitate the above, the ICDR amendment regulations have inserted a new chapter, Chapter 10A, Social Stock Exchange in the ICDR regulations, which deal with various aspects of an SSE and introduces the concept of a zero coupon, zero principal instrument, which can be issued by such NPOs. Further, the Institute of Chartered Accountants issued auditing standards based on the 16 categories of social activities specified by SEBI. The standards contain essential procedures and related guidance for the performance of each area of the 16 categories. These standards should be read in conjunction with the preface to social audit standards and the framework for social audit standards issued by the Institute and which are effective from the 14th of Jan earlier this year. Moving on to regulations applicable to debt listed company, or the regulation 52, SEBI has raised the bar on debt listed companies by focusing on public money at large. So where outstanding value of debt is greater than 500 CR at 31st March 21, these provisions would now apply to those debt listed companies. In terms of compliance and financial reporting, these changes now are pretty much aligned to equity listed companies, and in some cases, like disclosure of ratios, even more stringent compared with equity listed. The key changes include timelines for quarterly reporting, so 45 days except for the year end, which is 60. A statement of assets and liabilities and a cash flow statement along with half year results, also including related party transactions as part of the submission at the half year. A statement of utilization of proceeds. Such statement will need to be given till such time that proceeds are fully utilized. These now make debt listed companies fairly aligned to the requirements of equity listed companies, thereby demonstrating SEBI's intention here of increasing the focus on all companies that have public money involved. So these were some of the significant changes introduced by SEBI. We now move on to MCA and some of the related amendments. The MCA amended the accounts rules to mandate availability of books of accounts maintained in electronic mode to be always accessible in India. Also, there needs to be a proper system of storage, retrieval of such accounts and books and records. Also, companies are required to maintain the backup of such books and accounts in an electronic mode on servers physically located in India on a daily basis. In the past, this was expected to be done on a periodic basis, where such backups were maintained outside of India. The amendment further extends to disclosure requirements as per Rule 3.6 to include situations where accounts where they are maintained, stored outside of India by a service provider. The relevant details such as the name of such service provider, the location, their internet address, place of maintenance of such books, etc. are to be disclosed in the annual submission to ROC at the time of filing financial statements. These amendments got applicable from 11th of August and hence provided no transition time really to companies to make arrangements for such data and backups to be made available in India. This is likely to increase the compliance cost for maintaining backups, especially for companies that are part of larger groups, global groups that use centralized servers outside of India. To ensure compliance, it is best that companies undertake the required steps on an urgent basis. A related aspect to this amendment is where MCA also issued a notification to insert clause G under Rule 11 of the company's audit and auditor rules, requiring the auditor to report whether the company has used such accounting software for maintaining its books, which has the feature of recording audit trails for every transaction. The auditor in such cases is expected to check whether the trail feature could be disabled, whether the feature was available through the year, whether all transactions recorded in the software were covered in the audit trail, and whether the audit trail has been preserved as per the record retention requirements. The above is an onerous responsibility that has been cast on auditors, and it is best for companies to engage with their statutory to understand expectations. The role of IT trained auditors obviously would be enhanced in light of this requirement and reporting responsibility. Moving on to other amendments, the definition of small company has been relaxed. So now, if a company satisfies both the conditions of paid up capital and turnover of 4 crores and 40 crores respectively, which now has changed from 2 crores and 20 crores previously. So this would obviously result in more companies that could be categorized as small companies, and they could avail the exemptions that are available to such small companies, be it presentation of cash flow statements, to relaxation for conducting board meetings, non-applicability of mandatory audit rotation, so on and so forth. Moving to CSR provisions. So as you all know, the Companies Act had mandated CSR contribution of 2% of average net profits, where certain conditions of either net worth, turnover, or net profit were met. This was a novel concept and first of its kind to have been mandated under any law globally. The compliance has evolved over the years and now got even stricter. The requirement, as per the earlier rules of maintaining a CSR committee, where the eligibility criteria for CSR was not met for 3 consecutive years, the CSR committee could be disbanded. However, this has now been omitted in situations where there is any unspent amount of CSR. The CSR committee will need to still be constituted and will remain in existence. Companies having average CSR obligation of INR 10 crores or more should undertake an impact assessment to an independent agency for CSR projects above 1 crore. Expense towards such impact assessments shall be recorded not exceeding 2% instead of the earlier 5% of the total CSR spend for the financial year, or 50 lakhs, whichever is higher. Likely, this will allow companies to spend adequately to assess the impact of their CSR activities.
So moving ahead to NOCLAR. NOCLAR is the first of its kind framework to guide professional accountants in what actions they need to take in public interest where they note a potential illegal act or non-compliance with laws and regulations. Non-compliance with laws and regulations comprises acts of omission or commission, intentional or unintentional, which are contrary to the prevailing laws and regulations in the jurisdiction. Professional accountants have an ethical responsibility not to turn a blind eye to a NOCLAR or a suspected NOCLAR event. The International Ethics Board, or the ISBA, made NOCLAR effective from 15th of July 2017. However, our institute, in its 12th edition of the Code of Ethics, which came into effect from 1st of July 2020, whilst did introduce NOCLAR, deferred its applicability firstly till the 1st of April 2022, and further extended that till the 30th of September 2022 last year. Finally, the Institute issued the provisions with respect to NOCLAR for both members in service as well as those in practice under Volume 1 of the Code. The NOCLAR provisions apply to laws and regulations that have a direct effect on material figures in the financial statements and other laws and regulations that may be fundamental to the entity's business and operations. Non-compliance could result in fines, litigation, and other consequences that may materially affect the financial statements. Professional accountants should not only consider impact on financial statements, but also the wider public interest in terms of substantially harming stakeholders, including investors, creditors, employees, etc. Examples of NOCLAR are far-reaching. Could be fraud and corruption, bribery, money laundering, terrorist financing, proceeds of crime, securities market trading, and so on and so forth.
Finally, moving on to a quick refresher on some of the new and peculiar disclosures that were introduced for the first time last year under Schedule 3 or the revised Schedule 3. A few of these are fairly onerous and continue to create some practical challenges for companies. However, the intent of the disclosures was very clear. It was to enhance transparency with respect to certain of these areas. So first and foremost, details with respect to Benami properties where any proceedings have been initiated or pending against a company or holding any Benami property under the Act. Certain disclosures were mandated as part of Schedule 3. Relationship with struck-off companies where the company has any transactions with such struck-off companies under the Act, both under Section 248 or Section 560 of the erstwhile Act. The company is required to disclose certain details of such transactions about these companies. Date of declaration as willful defaulter and the amounts and the nature of defaults is the other requirement that came about last year. Loans and advances granted to promoters and details of such transactions. Disclosure of income not recorded in books earlier but offered for tax, and whether and a confirmation whether this income has been recorded adequately and properly in the books during the current year. CSR and details around amounts spent, the nature of activities, unspent amount, shortfall in provision, movements on provisions, etc. need to be also disclosed. With the increased sort of usage of digital currency, details of profit or loss on such transactions, amount held at the reporting date, advances or deposits received for trading or investment in these currencies, and so on and so forth are some of the peculiar disclosures that were introduced as part of Schedule 3. We obviously there are a number of other disclosures as well, but for this presentation we've restricted to some of the key ones that were introduced for the first time last year. With that, we draw close to our first episode of the year. Thank you for joining us, and I hope you found the session useful. We will be back with another episode of updates and year-end reminders soon. Till then, thanks once again and take care. Bye-bye.